Most traders are sleeping on this indicator, and honestly, I don't blame them. While it's not flashy or promise magical signals like your typical indicator, it's highly effective as it averages recent pivot highs and lows to create a dynamic ceiling and floor around price, then marks the exact moments when structure breaks with clean triangle labels. Turning messy swing structure into a visual framework you can actually trade, and it does it with almost zero lag. And in this video, I'm going to show you how it works, the perfect settings for different markets, and a complete pullback strategy you can use in your next trade. Let's get into it. To add this indicator to your chart, head to TradingView. Pull up any chart. I'm on 15-minute GBP JPY, but this works anywhere. Click on Indicators, type Pivot Trend Flow, grab the one by Big Beluga. This isn't your typical trend tool. Most of them use moving averages that lag or too sensitive and whipsaw constantly. This one takes actual pivot highs and lows, averages the most recent ones, then turns them into a dynamic ceiling and floor around price with zero lag, because it's based on structure, not smoothed price data. And in case you're wondering, here's how it works. The indicator collects recent pivot highs, averages them to create an upper reference line, then does the same with pivot lows for a lower reference line. So when price closes above those averaged highs, trend flips bullish. Green band wraps around price. And when price closes below averaged lows, trend flips bearish. Red band appears. You see this band right on your chart. That band is your dynamic support in uptrends, resistance in downtrends. But there's more. The indicator also marks structure breaks with clean labels. In bullish trend, when price breaks a prior pivot high, you get an up triangle, and in bearish trend, when price breaks a prior pivot low, you get a down triangle. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step without guesswork or emotions. If you want a free demo to see exactly how these strategies are applied in real market conditions, click the first link in the description. Now, to get the best performance from this indicator, let's get your settings right. First is pivot length, which I'll be setting this to 10. In TradingView terms, a pivot gets confirmed when you have 10 bars on each side of the turning point. No higher high for a pivot high, no lower low for a pivot low. About 10 bars left, 10 bars right, proving the swing is legitimate. Why 10, you ask? Because it gives you sturdy swings and filters. Tiny fake moves that don't matter. Lower like 5 gives more pivots, but more noise. Higher like 15 gives fewer pivots, but slower reactions. I found 10 is the sweet spot as it yaks fast enough to catch moves early and filters enough to avoid whipsaws. Next is AVG window for pivots, which controls how many recent pivots get averaged to create the band. I recommend you keep this at 5 as it makes it responsive without being twitchy. Enable fill color to fill the space between the bands, making bullish and bearish regimes visually obvious at a glance. Once that's done, click OK. Now me show you how to trade this 3 parts: foundation, setup, trigger. Part 1 is the foundation. Let the band set your bias. Here, the band color is your permission to trade. If the band is green, you're only thinking longs. If the band is red, you're only thinking shorts. Never trade against the band color. This keeps you aligned with the structural trend and prevents you from trying to catch falling knives or shorting runaway bulls. Look at this example. The band flips green as price closed above the averaged pivot highs, confirming bullish structure. That green band wrapping around price is your foundation. Part 2 is the setup. Pull back to the band. Now you wait. Don't chase price when it's extended away from the band. You want value, and value comes when price pulls back toward the band. Not through it necessarily, just toward it. In a green state, watch for price to retrace back down toward that green band. The band acts as dynamic support because it's made of averaged pivot lows, areas where buyers stepped in before. Now when price pulls back to it again, it means buyers are likely to step in again. In a red state, watch for price to bounce up toward that red band. It acts as dynamic resistance because it's made of averaged pivot highs, areas where sellers pushed back before. This pullback to the band is your entry zone, which means you're buying at support in an uptrend or selling at resistance in a downtrend. Part 3 is the trigger. Structure label confirmation. Here's where it gets precise. You don't enter just because price touched the band. You wait for the triangle label to confirm continuation. In a green band, you're waiting for an up triangle to appear. This prints when price breaks a prior pivot high that was established during the current green regime, which confirms the structure is still building higher. Buyers are still in control, and the pullback was just a pause before continuation. In a red band, you're waiting for a down triangle, down arrow. This prints when price breaks a prior pivot low from the current red regime, confirming sellers are still pressing and the bounce was just a pause. Make sure the label appear at a body close, not just a wick poke. This filters out fake breaks. Now we're going to layer in one more piece, volume. To do that, head back to your indicator search, type volume, and add the built-in volume indicator under technicals. Once it's loaded on your chart, double-click it, then go to the Style tab. Toggle on the volume MA and change its color to white so it stands out. Now you have green and red histogram bars showing volume per candle, plus a white moving average line as your threshold. Only take entries when the triangle confirmation candle has a volume bar that closes above that white MA, green bar above the MA for longs, red bar above the MA for shorts. Let me walk you through a real long setup so you can see how all the pieces come together. First, the band flips to green. That's your foundation band is green, so we're only looking for long opportunities, not shorts. We wait for price to rally away from the band. Eventually, price pulls back down toward that green band, which means the setup is now complete. We've identified our entry zone, right at that band where buyers stepped in before. Now watch what happens. Price touches the band and forms a strong bullish candle. At the same time, an up triangle appears on the chart, which means price just broke through a prior pivot high that was established during this green regime. Before we enter, we want to check the volume. Look at the volume bar for that candle with the triangle. It's green and it closed above the white moving average line, a confirmation that institutional participation is backing this move. Now we enter long. Place stop loss below the most recent swing low and target 1.5 times your risk. For shorts, first, band flips to red, telling you we're only looking for short opportunities now. Then price starts dropping away from the band and eventually bounces back up toward that red band. This means we've identified our entry zone right at the band where sellers pushed price down before. Next, price touches the band and forms a strong bearish candle. A down triangle appears on the chart, meaning price just broke below a prior pivot low that was established during this red regime. Now before we enter, we want to check the volume for confirmation. The volume bar for that triangle candle is red and it closed above the white moving average. Once we confirm strong selling pressure with institutional participation, enter your short position. Place your stop loss above the most recent swing high and target 1.5x your risk. Here's why this works. You're stacking 3 independent layers of confirmation on top of each other. First layer, the band gives you trend direction based on actual pivot structure, not some lagging moving average, real swing points that institutions care about. Second layer, waiting for the pullback to the band gives you value entry positioning, which means you're buying at support in an uptrend or selling at resistance in a downtrend, not chasing extended moves. Third layer, the triangle label confirms continuation by showing you a structural break in the trend direction. Price isn't just bouncing off the band, it's actively breaking through prior pivots, proving momentum is still building. Fourth layer, volume proves there's institutional money behind the move. Not just retail traders hoping for continuation, real participation from the players that actually move markets. When all 4 of these line up, you're not guessing about whether the trade will work. You're trading systematic confluence where multiple independent factors all agree on the same direction. That's the difference between gambling and having an actual edge. But the sad truth is, this system needs different settings for different markets. For forex, set pivot length to 10 and AVG window to 5. Focus on 15-minute to 1 hour where pivot structure is cleanest. For crypto, set pivot length to 8 and AVG window to 4. Crypto moves faster, more aggressively, so you need quicker pivot detection and band adaptation. For gold, set pivot length to 12 and AVG window to 6. Thanks for watching, and I'll see you in the next one.